Hello everyone, my name is Ngoc Khanh. I'm from the e-commerce class of Miss Nguyen, and today I'm going to present the case study Mobile Payments Fintech versus the Bank Giants. Here's the outline of my presentations. First, I will summarize the case study. Second, I will answer the 4 case study questions. And finally, I will share the conclusions. Let's get started. Mobile payments are transforming the way people shop and transfer money. Apps such as Apple Pay, Venmo, and Zelle are now replacing cash and cards in many situations. This case study shows the competitions between the fintech startup, big tech companies, banks, and retailers to dominate these fast-growing markets. It explains the 3 types of the mobile payments, how the millennials and Generation Z are the main adopters, the struggles of the fintech startups, and the rapid growth of Zelle. Fintech startups have introduced innovation by making payments faster and more convenient. For example, peer-to-peer transfer allows users to send money instantly. However, their weakness is limited scale and limited trust compared with bank and technology giants. On the other hand, banks have the strong customer bases, high trust, and integrated services like Zelle. Still, they face challenges because they are often slow to innovate and adapt to new digital habits. In comparisons, fintech are agile but small. Big tech is powerful with the ecosystem control and large user bases, while banks remain trusted but traditional. Now, let's move to the 4 case study questions. The first question is, what are the 3 types of the mobile payments and how do they differ? There are 3 important categories. The first is the universal proximity payments, such as Apple Pay, Google Pay, and Samsung Pay. This system uses NFC technology, allowing customers to tap their phone to pay at many merchants. Basically, your smartphone replaces your credit card, though adoption is smaller because not all stores have NFC terminals. The second type is branded proximity payments, like the Walmart Pay or the Starbucks apps. These work only inside one teller's ecosystem, but they combine the payments with the loyalty reward, promotions, and customer data. The third type is peer-to-peer or P2P payments. Examples include Venmo, Zelle, and Cash App. These apps allow people to send money directly to one another. For example, when splitting a bill, some of them are also accepted by the small merchants, but their main focus is personal transfer. In short, the difference is scope and purpose. Universal work everywhere, branded work only in one teller, and the B2B is mainly for person-to-person transfer. The second question is, which age group are most likely to adopt mobile payments app and why? The answer is the millennials and Generation Z. For example, in 2022, more than 70% of the millennials use P2P payments, compared with only 38% of baby boomers. Younger people are digital native, comfortable using smartphones for all kinds of tasks, including money. They do not rely on check like their parents, so mobile transfer are natural for them. They also enjoy speed, convenience, and even social features. For example, Venmo allows users to share payments active with friends. By contrast, older generations like Gen X and baby boomers are slow to adopt. They prefer credit cards because of trust, habit, and privacy concerns, so the millennials and Gen Z are clearly driving the growth of the mobile payments. Move to the third question. Why have fintech startups had a hard time competing with the tech giants? At first, the fintech startups seemed ready to disrupt the payments industry, but in practice most of them struggle. Big tech companies like Apple, Google, and Samsung have the huge advantage. They control both hardware and software ecosystem, and their wallets are often pre-installed on smartphones, which make adoption simple and cheap. They also have the massive customer bases and global brands that people already trust with their data. Meanwhile, banks have the infrastructure, experience with fraud prevention, and huge customer network. For fintech startups, the barriers are high. They must spend heavily on marketing, partnership, and regulatory compliance. Many cannot survive on their own, which is why companies like Venmo were acquired by PayPal in 2013. The lesson is clear: innovations alone is not enough. Scale, trust, and distribution channels are just as important as technology. Moving to the last question, what is Zeller and why has it grown so quickly in the last few years? Zeller is peer-to-peer payments service created by major U.S. banks, including Chase, Wells Fargo, and Bank of America. It allows almost instant transfer using just an email address or a phone number. What makes Zeller unique is that they're directly integrated into existing banking apps. Customers do not need to download another app and create a new account, which gives a huge distribution advantage. Zeller grew quickly because it is supported by more than 10,000 banks and also works with the Visa and MasterCard. Transfers are instant, free, and secure, and people feel safer using systems backed by their own bank. It also benefits from network effect. As more banks and users join, it becomes the default peer-to-peer service. By 2022, Zeller has over 60 million users and processed more than $365 billion in payments, for more than Venmo. This shows how the traditional bank, when they cooperate, can not only defend their position but also outgrow fintech rivals. To conclude, there are three types of the mobile payments, each with different purpose. Young generations, especially millennials and Gen Z, are main drivers of adoption, while older generations are more cautious. Fintech startups bring the innovations but struggle against the power and the scale of big tech and banks. Zeller demonstrates the strength of trust, integrations, and scale. Overall, the mobile payments industry is dynamic and fragmented. Customers still rely on cards, but digital solutions are growing rapidly. The real winner will be those who can combine technology, trust, and convenience more effectively. That's my presentation. Thank you for listening.